Welcome to Investment Management. This video will cover Chapter 2, and then I will cover Chapters 3 and 4, parts of 4 for the MIS class that we had. Let's jump right into Chapter 2. I'm going to talk about margin and opening up a margin account and what it means and why people take on margin. So what's the motivation for margin? Margin is motivated by, opening up a margin account is motivated to take on leverage. And we'll look at that and we'll explore that towards the end. But before we get into that, let's talk about what actually margin represents and what a margin account does for you. A margin account lets an investor borrow money. But the ironic thing about it is, and you need to keep this in mind, is that margin is not the loan that you're getting from your broker. Margin represents the equity that you have in the transaction, the skin in the game. And so what happens is normally you have an investor. Here's the investor. You have a broker, and you have a bank. And what happens is you're going to borrow money from the broker. Okay? And that broker is going to borrow the money from a bank because the broker is going to consolidate all the borrowings and end up borrowing money from a bank on this. So that's the direction of the way money flows. Now, the interest rate that the bank lends brokerage firms is called the call money rate, call money rate. And then your broker, which is, they're in the business of making a profit, they're going to charge you the call money rate plus 1% on top of that, like a spread. And then you'll end up paying that interest rate. Now, margin, there's two forms of margin. There's one is initial margin, and that is the initial down payment that you put on a stock. And that is required to be a minimum of 50% by the Federal Reserve. And before I go any further, you might ask, well, why is the Federal Reserve involved? If you're really listening carefully, the Federal Reserve monitors banks, not brokerage firms. But it does in a sense, because if an investor goes belly up and didn't put enough skin in the game and they end up going belly up, but going bankrupt, brokerage firm could go bankrupt, which means the bank could go bankrupt. And we have fractional reserve system, and so a single bank going under could cause a domino effect. So and that's exactly what happened in the 1920s. In the 1920s, we had a roaring stock market that crashed in 1929. But before the crash, when the stock market was doing really good, investors could buy stocks with only a few pennies down on the dollar. In other words, they could borrow 90% or more of the value of what they were buying and only put in 10%. So if a stock cost $100, they could put in $10, maybe $5, and borrow the rest. And so it didn't take much. If the stock fell by $5 or $10, their equity would be wiped out. And so that underlying stock represents the collateral to the loan the broker's making you. Okay, so the Fed is involved in the initial margin requirement, minimum to be 50%. Your broker can charge a higher rate, and that's all of this that I'm talking about in this in this area of margin will be spelled out in your margin account application that you would sign. And in there'll be the house rules on what the margin requirement is for particular stocks. Some stocks have slightly different margin requirements. There's margin requirements for bonds, which we won't get into. We're going to focus mainly here on the concept of stocks, because once you understand how margin works with stocks, you can apply the concepts to bonds, the options, and the futures contracts. They're a little different. Their margin requirements are a little different, and it's a function of how those other securities operate. But once you get a handle on margin with stocks, you can be pretty adaptable to figuring out other margin requirements. Okay, so initial margin requirement's 50%. The second form of margin that's required is called maintenance margin. Maintenance margin is I'll just call it maintenance. Maintenance margin is the minimum margin that your account cannot fall below. In other words, it's like a floor. It's like a trigger point. So if your equity falls below this maintenance margin requirement, then what happens is you're going to get a house call. And we'll go through what that means shortly. Before we get any further, we have to define how to calculate margin. And margin, and I'll put it in percent for the moment. Calculating in percent, you ought to be able to do it in both dollars and percent, as you'll see in a few minutes. Margin, like I said, is your equity. And it's in percent, it's your equity divided by the market value of what you're buying. And if you multiply it by 100, you'll get this into a percent form. Okay? Now, how do you calculate this equity, the top part? Well, in this whole fraction, it's your market value of what you're buying minus, ignore that little dot there, minus your liability, your loan from your brokerage firm. I'll put that together here. That's your loan from your brokerage firm, and then divide it by a market value of what you're buying. That is how you calculate the margin requirement. And so if you notice right here, market value minus the loan, that's your equity in a dollar amount. That's your dollar amount of your equity. This is the skin in the game you put it. So you bought something with the market value of MV minus the loan that you got from your broker. That's your equity. Because what if you do a balance sheet, which I'm going to show you in a minute, examples of, you have assets, you have liabilities, you have equity. Remember the old accounting identity. And so you're going to have the market value of assets. You're going to have a loan here. And then what's the difference? Market value minus the loan's got to be this equity component. So this is equity. Okay. Let's actually get into an example and drive this concept home. Okay. Assume you purchase 200 shares of AT&T stock at $60 per share. So that's 200 shares. And by the way, I'm following your notes carefully. The notes for Chapter 2 carefully. 200 shares of AT&T, $60 per share. Okay. The initial margin requirement, initial, is 60% set by your broker, and maintenance, MM, is 30%. So your equity can't fall below 30%, or you're going to get what's called a house call, which means you need to kick in more equity or more skin in the game. Okay, so the question is, how much money do you need to pay the broker now, which translated into this language means how much margin do you need to post, do you need to put in skin in the game. So how much money do you need to pay the broker now if you borrow the maximum amount allowed? Well, the initial margin requirement is 60%. A margin is going to be the market value minus the loan. So the market value is 200 shares times 60 is 12,000 is the market value. The loan is what we're going to solve for, and the market value is 12,000. So if you recall, cross multiply these two and set them equal to get rid of the fraction. So that's 7,200 equals 12,000 minus L, the loan. And the loan comes out to be 4,800. This is 4,800, which means your equity, you're going to have to put in 7,200 to satisfy your broker. So you put in 7,200, your broker puts in 4,800, and you buy the stock for 12,000. It should, and a good way to check to make sure you got it straight is see if you can put together a balance sheet on this. So your market value is 12,000, your loan is 4,800, and your equity is going to be 72. 12,000 equals 12,000, and your balance sheet balances like it should. Okay, now let's go one step further. Let's ask, Suppose the stock immediately after you buy it falls to $50 per share. Is there a margin call? Do you have to put more equity in? Which is really a question of have you fallen below the maintenance margin of 30%? Well, let's look. 10,000 is the new value. The 200 shares times 50 minus the 4,800. You still have that $4,800 loan divided by 10,000. That equals 52%. I'm not multiplying it by 100 here. You can figure out that's 52%. And so, no, we haven't fallen below the 30%. So there is no house call. But since you've fallen below your initial margin requirement, it's possible that your account may be restricted. You're going to have to read the house rules that you sign. I mean, that's a lengthy document. If you go to the web and you look up the rules, the margin account terms, so to speak, you're going to get lengthy documents that look like a lawyer wrote them up, and that's because a lawyer did write them up. And so it spells out, the interest rates associated with the loans, which I'm going to ignore here in this class. There is, if you borrow the money, an interest cost, but it just muddies up the calculations and the concepts, just like taxes and brokerage commissions apply, but it just makes it a little more cumbersome to work through the math, and I want to get right to the concepts. So we ignore commissions, we ignore taxes, and we ignore interest on the loans to keep our head straight. Okay, so in this case we have a restriction, possibly a restriction on the account. Now let's continue the example. Suppose the stock falls instead immediately to $30. Is there a margin call? And if so, how much? Well, 6,000, that's the 200 shares times $30, minus the 4,800 divided by 6,000. That equals 0.20. Whoa, that's below the 30%. Right? It's 20% equity at this point. That implies a house call. But the question is, how much do you need to kick in? And so keep in mind, your broker's not going to ask you to write a check with a % on it. You got to put it in dollars. And so that's where the calculations, that's where we're going next, is how much? Well, before you go there, you got to ask, do I have to bring it up to the 30% or do I have to bring it up to initial? So do I have to bring it up to maintenance or initial? Well, you got to read the house rules to be clear on that. Typically, we assume that you have to put it back up to initial margin, which in this case is 60%. So if that's the case, we're going to figure out what we're going to do is we're going to figure out the house call by figuring out what the new loan ought to be, what the maximum new loan ought to be. And then we'll pay down the loan, and we pay down the loan, that puts more skin in the game on our part because we put more money into the account, and it reduces the broker's risk because the collateral fell in value. Okay, so let's do the calculation. 6,000 is the value minus NL, that's the new loan maximum that we can have in this case, divided by 6,000, has to equal 60%. We got to bring it back up to initial. If we cross multiply, we get 3,600 equals 6,000 minus NL, and then NL is 2,400. The maximum loan that you can have is 2,400 at this point. Well, the old loan was 48, right? That's the old loan right here. The new loan can only be 2,400, which implies we have to pay back 2,400. That's the house call, or what's called a margin call. It's $2,400. It's a check you're going to have to write out or deposit somehow, get it into the brokerage account. And so let's make sure that we have our head on straight here. Ignore that, some of that noise in the background. It's my heater in my office. Nice sound studio I have here. Let's make sure we have it. Now the market value of my assets is 6,000 at this point. My new loan is 2,400, and my equity is 3,600, and so it does balance at 6,000. And so you can check this 3,600. It was originally 7,200, right? But then we lost. I lost, or whoever bought this lost. They lost $6,000 because it went from 12,000 to 6,000. in value, so that's a loss. And then, but we added in through the house call, the margin call, $2,400. So now we have $3,600. So the point of this is, there's different ways of getting at this, but you should be able to reconcile it another way. Come at it from a different angle so that you can check your work. And that's what I'm doing. So you get the intuition from that. Okay, now let's go on to the leverage effects that I talked about earlier. And on the top of page 3 of the notes, it says, as in the earlier example we just covered, you purchased 200 shares of AT&T stock at $60, right? Yep, we did that. The initial margin requirement was 60%. And the stock, let's assume now, instead, the stock increases to $90 after you purchase it. What is your total return? Okay. Well, before I answer that, let me look at what our total return is if we bought the stock in full and we paid 100%. In other words, there was a 100% margin requirement. What would be the return? Well, the market value, so this would be the market value at the end of the period minus the market value at the beginning divided by the market value at the beginning. That would be our return, total return. And so this would be 18,000, which would be the $90 times the 200 shares minus the 12,000 we bought it at divided by the 12,000. That is 50%. Okay, that's our total return if we paid for everything in full. No, we didn't borrow anything. Now, what happens if we borrowed? Well, the formula is the market value is the ending minus the market value at the beginning. That's still our capital gain or loss divided by our initial investment. And our initial investment is basically initial. That's our initial margin requirement. And so what that boils down to, it's the 18,000 minus the 12 divided by the 7,200, our initial margin requirement. That turns out to be 0.833 or 83.3%. Okay. You can do the effective annualized return, and that would be 1 plus 0.833 to the how many holding periods do you have in a year? This happened over 9 months. If you read the question carefully, it says the stock went from 12,000 to 18,000 in value. Your position changed by that 6,000 over 9 months. So how many holding periods of 9 months are there in a year? Well, it's 12 divided by 9. That's how many holding periods. So that's 1.3 minus 1 gives us 1.24 or 124%. Okay. So now you can see, look at the leverage effects. Look at those leverage effects. If the stock goes up like you thought it would, that's the only reason you'd buy it, then you're magnifying your results 50% versus the 83. So you're getting that 83% return, which is pretty good. Now, if the market falls against you, you're going to have, let's say the stock drops to $6,000, and this is now 6,000. So this is now minus 50%, and this is 6,000 here. You are now minus 83%. So that will work against you. So there's a double-edged sword of leverage. And not just opening up a margin account, but any account or anything that you have leverage with, you have this double-edged sword. So how do we represent that? Well, let me try here. Here's the stock. Put a 0 here. And I'm going to put in a total, I guess, yeah, so I'm going to put in a total return and dollars. So total return in percent in dollars. We're going to have like a double axis here, as you'll see in a second. It'll make sense. So here we have the $60 we bought the stock at. If we paid the stock in full, no margin, okay, we'd have a slope of 1.0 for this equation, because for every dollar it went up, the stock goes up, we would make $1 in total in profit, right? And we would have let me go back this way. If we lose $1, if the stock drops $1, we'll lose $1. So this has a slope of +1. Okay. Now let's translate what happened into also the percent here. So if the stock goes up to 90, like we said, we come over. That's a $30 profit per share, or what we calculated earlier to be a 50% profit. Okay. If the stock drops to $30 a share, then we're going to lose $30 a share, or in other words, minus 50%. Okay, so that has a slope of 1. Now, let me get another color out here. See if I got green and see if it comes up on the screen. When we buy on margin, that's a straight line. If we buy on margin, we have this leverage effect. And you can see that with the steepness. Look at the steepness, how the slope changes in steepness. It's a slope of greater than 1. And so what happens is we now have losses that are now 80, or gain here in this example. This gain is 83%. Quite running out of space up here, but that gain is 83%. And the loss is minus 83% here also, as you continue down. And so what you see here is you see this, the more you're leveraged, the more you swing in this direction, the steeper this slope gets, the more risk you take on, because it only takes a little drop, right? A little drop this way to cause you to go down very quickly, down this way, down to the bottom. And so the other thing to keep in mind is that you can lose more than 100% of your investment with buying on margin, because you're leveraged. You can lose your $7,200 and then some. Remember, the market value of what you bought the securities at was $12,000. So if you have losses of $7,200, right, you just lost 100% of your money in a sense, the down payment that you put on. And so your return will actually go negative once you lose more than $7,200. Okay, now the question that the textbook raises, and it's an important question, if you take the series, I forget, series 63, 6, or 7, I'm not sure which one, but those securities licenses exams that you take, they're going to ask those type of questions. At what price are you going to get a house call? Now keep in mind that the formula is market value minus the loan divided by market value, and that equals, I'll call it little m for the margin requirement. This is initial margin, and it also applies to the maintenance margin. But so now what we want to do is we want to figure out at what price do you get a house call. Substitute P times Q here, because this is the price times quantity, P times Q. And as I have in the notes, if you go through the algebra, which I do pretty meticulously in those notes typed out, you come up to P star, which P star is the price at which you get a house call, as being L divided by Q, the loan per share. So that's the loan per share. You know, it doesn't have a whole lot of meaning, but it does have some meaning to it, but not a whole lot, you know, in terms of intuition. But that's loan per share divided by 1 minus the margin requirement. So if we continue with the example of purchasing 200 shares at $60 a share with initial margin requirement of 60%, the price at which we'll get a house call, which has to be below the $60, by the way, that's when you're going to get the house call, is going to be the $4,800 loan divided by the 200 shares divided by 1 minus 0.6, which is 34.80. So if the stock goes from 60 to 34.80, as soon as it hits 34.80, it triggers the house call, because your equity has fallen below the maintenance margin requirement, or just actually hit the maintenance margin requirement, and you're going to get a house call. And you can check that. You can check, because at 34.28 times 200 minus the $4,800 loan divided by 3428 times 200, that equals 30%. So you just hit the trigger area. Okay, now let's go right into short sales, and then we'll go into short sales margin. Okay, so now short sales is you take a position to make money when the stock drops. So what you're going to do is you're going to transact business in the reverse chronological order. Normally what you do is when you short sell something, you sell the stock first, and then you buy it back later. So you sell it high, say at $100, hope the stock drops to say 70, and you make a $30 profit as you buy it back at 70. So you sell it at 100, buy it at 70, and you get a $30 profit. Okay. Your brokerage firm will be lending you the shares, and that's the point here. When you borrow, and when you go do a short sale, you're borrowing stock. You're not borrowing money. Like when you're long position, what we just went through the past 20 minutes was going long, you're borrowing money to buy the stock. Here you're borrowing the stock from your broker to do the short sale. So your liability is the shares. You got to return those shares to your broker. Okay. Now there's a couple of different ways that your broker can get those shares. Your broker can take them out of somebody's account, or your broker can go through a network, a market, so to speak, for loanable shares. And so some mutual funds make extra profit by loaning their shares out for short sellers. So there are additional costs associated with it to the investor for short selling, because you got to get these shares, and it takes extra work on the part of the broker. Now some people have a problem with a brokerage firm borrowing shares from somebody's account. They don't even tell the people they borrow the shares. They just take the shares out of somebody else's account, say at Bank of America, Merrill Lynch. They take the shares out of somebody else's account. They effectively give them to you. The broker controls the whole situation, but they sell the shares for you, and the broker keeps the money in an account. The broker would never let you sell the shares and then you keep the proceeds, because people would just come in and sell massive amounts of stock, get the proceeds, and disappear. So your broker controls the situation. Now, the fact that your broker can borrow those shares from somebody's account shouldn't be troublesome to you, although it seems to be troublesome to some people. And so here's the analogy. The analogy is this. Let's say you go to a bank and you deposit a crisp, nice $100 bill at the beginning of the year, and you look at the serial number on the $100 bill, and you deposit it. You know a couple of things are going to happen. One, when you come back a year later, or even a week later, or an hour later, you're not going to get that same bill back, that same $100 bill. You know that. You're going to get a different bill, for one thing. And the other thing is, you know that if you deposit that money in the bank, what's the bank going to do with it? Is that bank just going to sit on that $100 bill and it stays there in the vault? And the answer is no. You know for a fact that it's going to be lent out, because the broker has a profit, or the bank has a profit motive. They're going to lend that out. They're going to take it out of your account without telling you, and they're going to lend it to some corporation, business, or or a person for a mortgage, say. And so there goes your money out the door. They're not telling you, but they'll replace it when you come back to make a withdrawal. So don't get hung up on that issue. Now, let's do an example of short selling. Suppose you expect the price of General Motors to fall soon, so you short 100 shares when the price is $100 per share. You expect to buy it back in 1 month when the price is $80 per share. During this period, the stock pays a $2 dividend. What is your profit on the transaction? Now, I didn't talk about dividends, but when you have dividends, you're going to have, that stock pays a dividend, you're going to be responsible for the dividend. The dividend will actually be an expense, because what's happened is you've taken the shares out of somebody else's account and sold them to a third party. The third party is getting the dividend. The people the person you took the shares out of the account of, your broker took them out, it needs to be made whole. So you're going to be responsible for the interest. It's kind of like the bank story again. If you put money in the bank and you expect to earn an interest rate, well, the bank's going to lend it out and collect an interest rate from you for the loan, or from whoever borrowed the money. Okay? So you're responsible for dividends. So in this case, the profit on the short sales is going to be the sales proceeds. That's $100 times 100 shares. That's $10,000 proceeds. And then the cost, we're going to buy it back for $80 a share. At least that's what we expect to do. So that's our cost. Okay. And then we have dividends that we have to take care of, and that's $2 times 100, which is $200. And so our profit is $1,800. There goes my heater again, making some noise. Okay, so that's my profit, $1,800. I just made money on a stock that falls in value. Okay, let's go to short sale margin. Now, you might want to take a deep breath because it gets, some people, okay, they can just handle margin for a long position, and buying stock long is, they're used to that. But shorting, then you go to shorting, and that's a little twisted, and then you start talking about margin relating to a short position, and it gets even more twisted. But it's really not that bad. So I'm not going to cover it too in depth. But I'm going to get to the basics, the heart of it. When you short sell a stock, you must keep the proceeds in an account. Plus, you need to put in a margin requirement. So when you short sell, you put the proceeds in an account. Your broker will do that automatically. Then your broker is going to ask you to meet a margin requirement, which is typically 50% or more, which means 50% of the proceeds, you have to add another 50% of the proceeds to the account. So your account balance will be the proceeds plus the initial margin requirement, which is often 50%. Let's do an example. Suppose you short 100 shares of Microsoft for $50 a share. The initial margin requirement is 50%, and the maintenance margin is 35%. How much money will you need to deposit in your account to meet the margin requirement? And how much will you have in your account? Well, let's take a look here. You're going to have to figure out your account value, how much money is going to be in your account. You got the sales proceeds, right? And that's going to be $5,000, right? Because you sold $50 per share times 100 shares is $5,000. The initial deposit, the initial margin deposit was $2,500. That's 50% of the $5,000. Your account balance will now have $7,500. Okay. Now, notice you've met the margin requirement according to the formula. So margin is your equity divided by your market value. Your equity is $2,500. The market value of what you sold was $5,000, so it's 50%. There you met it. Verify it using a balance sheet. Okay. You have proceeds, $5,000. You have your deposit, which is your margin of $2,500. Here's your account for $7,500, just like we have here. Right? You have a loan, but the loan now is not in dollars, it's the value of the stock, which is basically P times Q, which is the price is $50 per share, it's 100 shares, 5,000 is the liability. Your equity is the 2,500 from here. Does it balance? Yes, 7,500 equals 7,500. Right? And there you got it. Pin that down. Now the question is house calls with a shorted stock. Now, before you go any further, you realize that a house call is going to happen when the stock goes up. So you got to get used to that because your equity is going to wear away if the stock goes up. When you short sell a stock, the worst thing that can happen is the stock goes up. So if you short it at $100 and it goes up to $120, you got to buy it back for $120, which means your sales proceeds are $100, your cost is $120, and you lost $20 per share. Okay, now the formula for determining the margin level for a short sale is margin requirement is going to be your account value minus P times Q, which is your liability, divided by the market value of what you just bought, which is P times Q, or what you just sold. Okay, that's your equity divided by your market value of your assets. You can solve for P star, by the way, the price at which you'll get a house call, and that's going to be your account value divided by Q divided by 1 plus M, which is your margin requirement. So using the data from the previous example, you can compute the price at which you get a house call. So I'm at the bottom of page 6 of the notes. So that's going to be P star is going to be 7,500 is my account value here or here, right? Divided by 100 shares divided by 1 plus 0.35. Oh, and by the way, this M is the maintenance margin requirement because we're talking about, we're talking about a house call, and when you get a house call is when you hit the maintenance. So this is not initial margin at that point. And so this P star comes out to be $55.50. So look, we shorted the stock when it was at 50, right? In this example with General Motors. Now it goes up to 55.56. Our equity wears away, and now we get a house call. How do we know our equity wore away? Well, the market value is 7,500 of our account minus the 55.56 times 100 divided by 55.56 times 100, and we get 0.35, which is the maintenance margin. So we're right at the limit there. Okay. Whew. Now, let's go on to the last page of the notes. There's no math here. We're just going to talk very briefly about investment strategies. And then I'm going to talk about asset allocation strategies. So there's a couple of elements to a strategy that needs to be addressed when you put one together. And the book outlines it and asks various questions. For example, if you're going to have money at a brokerage firm or have a financial advisor, you're going to need to ask questions. Who's going to make the buy and sell decisions for you? And you need to figure who that's going to be in the firm. And will the decisions be, or they could be your decision. They could be your decision in part made with the actual investment advisor. Or if you have your money put in mutual funds, for example, then you're not going to have any say in the outcome there. It's got to be professionally managed. You also have to ask, of the person, if it's you or the person you hire to actually buy the stocks for you, the market timing. Who's going to, how's that going to happen? Are you going to try to time the market, beat the market through timing? You should talk about that, because that's good. If it's timing that you think you can beat the market through timing, you better have somebody with some good skills. The third thing is asset allocation. How much money do you want to allocate to the major asset classes? That should be your decision. You may end up delegating it, or your client may delegate it to an advisor, which could be you. And so you need to take that into consideration. Who's going to determine the asset allocation? And then security selection. Who's going to actually select the securities, which is kind of related to, the market timing issue up above. So those are items that you need to consider. Some of the items you need to consider for investment strategies, not only for yourself, if you're managing money for yourself, or have somebody managing it for you, or you're the advisor. You need to clarify whose responsibilities are what there. Then there's a couple of other things here at the bottom. We talk about strategic asset allocation. Strategic asset allocation. When you hear the word strategy in there, it means you're taking a long-run view of the financial markets and yourself. And so what you're doing is you're putting together an asset allocation where you want to keep the weights relatively constant over time. They won't be perfect, because the minute you buy a position that has 60% weight in stocks, the minute stocks go up relative to bonds, you're not 60% anymore. So within reason, you're going to have to keep those ratios about the same. So you're going to have to rebalance periodically with a long-run strategy of keeping those weights relatively constant. Then there's compare that to tactical asset allocation. That's where the investor reacts to what the market is doing, and sometimes reacts to based on their own personal experiences, reacts to what the market is doing to try to beat the market. Okay, so tactical allocation is often short-term in nature, and somebody's moving in and out of the market to try to take advantage of changes in the market. Okay, that ends chapter 2. Okay, so chapter 3. Okay, chapter 3 is fairly simple chapter. It's not very quantitative. A little bit of quant that I show you is respect to options, and I'm not going to expect you to know how to calculate options profits. I teach a whole course, and I'll be teaching it this summer on financial engineering, which includes options, futures, and swaps. So I'm not going to go into it heavily, but I'll show you some calculations but you just won't need to know them for an exam. Okay, so basically this chapter covers an overview of security types, and there's interest-bearing, there's equities, and there's derivatives. Now, interest-bearing, there's various categories. There's money market instruments, there's fixed income, which are bonds, and so let me cover those examples. Let's turn to that page 2 of the notes. And examples of money market instruments. So these are called money market instruments. And so examples would be treasury bills. Treasury bills are debt issued by the government. So when you buy a treasury bill, you're lending to the U.S. government. And so treasury bills have maturities of 1 year or less. They're sold at a discount, which we'll calculate in chapter 9. But these things are, there's billions of dollars worth of treasury bills out there. They're auctioned every month, or in fact every week they're auctioned on a Monday. Treasury bills are auctioned off, and you know, the individuals and firms with the highest yield, that they're the highest price, which means price is high, the lowest yield, are the winners to that auction. And we'll talk more about that auction later, but these are securities that are sold at a discount. And so they have, they're short term, there's very low risk, because there's no chance of default on a treasury bill. It defines, by the way, our treasury bill, the treasury bill defines the risk-free rate, RF, that we will be using later on in this course a lot. And so you buy these treasury bills at a discount, and they mature at a nice round face number, and the difference represents interest income. These things are very low risk, very low return. There's not a lot to analyze. So when you take an investment management course, you don't spend a lot of time on money market securities. There's just not enough there to grab a hold of analytically to talk about. The second type of money market instrument that we're looking at is negotiable CDs. These are large CDs. These are unlike, they're kind of like, but they're not like the CDs you buy at a savings and loan or a bank. You open up a CD with a bank, it's just between you and the bank. You basically get a receipt that you made a deposit, and that money will grow over time, and you're telling the bank that you're going to keep the money in there for a certain period of time. So it's money that's locked up over a period of time. So the bank, knowing that they have that money for a longer period of time than, say, a checking account, will pay a slightly higher rate. And CDs have maturities that are similar to treasury bills. Okay. Now, negotiable CDs, the difference here is between that and retail CDs. Negotiable CDs can be traded. You can't trade a retail CD with your friends or in a market somewhere. It's just between you and the bank. But with large CDs, negotiable CDs, they are tradable at the institutional level. Now, the third type of and we're only covering 3 here, but there's many other types of money markets. And the third one is commercial paper, which is very short-term, unsecured debt that's issued by corporations with high credit standings. And for example, this is, companies with high credit standings are General Motors Acceptance Corp., General Electric Acceptance Corp., the big banks, companies that have household names, because companies with household names can issue short-term debt without putting collateral up. And that's the neat thing about commercial paper. Commercial paper commercial paper also can be issued on the dime, so to speak, very, very quickly. Normally, when you issue securities, you got to go through the Securities Exchange Commission. You got to get the accountants, the lawyers. They got to plan things out, and the market's not doing well. You can't issue it. It takes forever to go through that process. I've done it when I worked in a bank. You got to get investment bankers to help you out typically. And so the issue of securities, most of the time, it takes a lot of work, and it could take months before you actually get the money. With commercial paper, it's different. You can set up an agreement ahead of time and put these securities on the shelf, so to speak. So long as you borrow the money for less than 270 days, according to the rules, then you can, on the spur, once you get the initial approval, on the spur, you can borrow money any given day, or 5 times a day, or any given day to borrow this commercial paper. So this is the lifeline for many financial institutions that need short-term liquidity. So the commercial paper market is in the billions. Lots of money transacts in any given day. Okay? The commercial paper market is not as active as it used to be. It was the commercial paper market was the one of the markets that froze up in 2008 and 2009. And just briefly, what happened was the commercial paper market was so attractive because borrowings could be made instantly, that non-household name companies wanted to get in on the action. So how do you borrow money in the commercial paper space, so to speak, as they call it, without having a household name? How do you borrow that money on an unsecured basis? Well, what these guys figured out was we'll put collateral behind it, and so they won't be unsecured, and we'll put collateral, and that kind of reduces the risk to the borrower. And so as long as we issue these commercial papers, notes under 270 days, we can issue them on the dime very quickly. Now, what was the collateral that they used? You got it, mortgage-backed securities. So they had mortgage-backed securities as the collateral behind commercial paper. And that's the source of the problem. There was a lot of subprime mortgage-backed securities that were used as collateral. There was a lot of financial institutions did not know the extent of the collateral, the type of collateral that was used for their lending. In other words, when they bought the commercial paper. So that caused people to freeze, lock up, and not want to commit any money to buying commercial paper, which means financial institutions couldn't fund themselves, which meant gridlock in the financial systems. There's a much longer story to it, but that's as quickly as I can boil it down to. Now, the next category is fixed income securities. Those are longer term things. Those are bonds. So you took your previous finance course, you know about fixed income debt. We will cover this more extensively in chapters 9 and 10. These have more risk because they're long term. So it's long term borrowing and lending going on here. It's often by corporations, which would imply risk, the chance of defaults there. It could be issued by municipalities, tax exempt debt. It could be treasury securities. It could be agencies, government agencies issuing the debt. And so we'll cover, like I said, we'll cover that in later chapters. And you kind of have a feeling for it already, because you had to, in order to get into this investment management class, you had to have taken a previous finance course, which you covered how to value those. We're going to cover how to value those again in chapter 10. And but that's a few chapters away. There's also common stock, which is a good component of this course, which represents ownership in a corporation. Shares have voting rights. They pay dividends often, but not always. And the dividend is subject to board of director approval quarterly. And so if a company goes bankrupt, you're the one holding the bag, so to speak. If you own those common shares, everybody gets paid off before you. So you owe your creditors, you owe your employees, you owe the pension plan, you owe your bondholders, and you owe preferred stockholders money. And once they're all paid off, whatever is left over, a common stockholder gets. So you're called the owner of last resort. Now, as I just mentioned, there's preferred stock. Preferred stock is a little, here, let me show you. Preferred stock is kind of like a hybrid security. So here you got your balance sheet, here you have your assets, here you have your liabilities, here you have your equity. Now, normally you have common stock down here, and here you have bonds, right? Now, what's a bond? A fixed income security. Well, it periodically, and you know exactly when, every 6 months, the bonds will pay a coupon, which is known ahead of time, and it's fixed typically. That's why they're called fixed income securities. So bonds pay an annuity, stocks pay dividends. Now there's a thing called preferred stock that's kind of a cross between bonds and common stock. Preferred stock pays a dividend, so it sounds like a stock, but that dividend is fixed over the life, and so it's kind of like a bond in a sense that's paying a coupon payment, but they're called dividends. So this pays an annuity basically. It typically doesn't have the voting rights that common shareholders have. And since preferred stock is basically has an annuity associated with it, they often go up and down in price based on interest rates, kind of like bonds do. Okay, let's get into options in futures contracts. Now, options in futures contracts are called derivatives, as are swaps also, because let's look at options. Options they're derivatives because they derive their value from other assets, the prices of other assets. So a stock option, for example, gives you an option to buy or sell a certain number of shares of stock during a certain period of time. The size of an option contract is typically 100 shares. Okay? Now, there's two types of options. There's call options and put options. I mean, there's many types of options, but these are two ways, the most basic ways of categorizing them. So there's call options, and a call option means you're bullish on the stock. You buy a call option, you hold a call option when you expect the stock to go up in value. And so let's assume that you buy, and the example here is a June call option. What that means is between now and June, you have the right to buy 100 shares of Apple stock, common stock. And these options cost you $3 because there's a premium to buy an option. There's a premium associated with it. And the strike price is 100. So what this does is this June call gives you the right to buy 100 shares of Apple stock at $100 per share. Okay? You have the right. You're not obligated to do it. You have the right to do it. And it's going to cost you $3 for this option. Now, what happens at expiration if the stock ends up at 98? Well, if it ends up at 98, would you want to buy the stock at 100 through the option when the stock trades in the open market at 98? Nah, that doesn't make sense. So the option is going to expire worthless. And so you can graph these relationships. Again, this is not what you're going to get tested on, and make sure you hold me to that. So here's a call option. Here's I'm going to show you what's called hockey sticks, just briefly to show you how an option works. Here's the strike. So the way these things work is you draw this sideways T, put a zero here, a dollar amount here for profit. Here's the stock going back and forth in price, and here's the strike. In this case, it's $100 for Apple stock. Now, when the stock falls below $100, you never want to buy it for $100 when it trades in the open market for less. It's kind of silly to exercise the option. So the option costs you $3. That's what you lose per share, $3. So the analysis is on a per share basis here because the stock is a per share. Then once the stock goes above 100, it begins to make more money. We call it a positive payoff. And it'll kink it here right at the X. And at a point, you'll break even at 100 plus the $3 premium because you got to cover that $3 cost. On $103, you'll break even. And then for every dollar it goes up, you'll make $1 in profit. So it has a slope of 1. These are sometimes called the hockey sticks of options because it shows you the risk and return profile using hockey sticks. So this tells you the most you can lose is $3 per share, but you have unlimited potential gains all the way up, which is some people like very much. They like that limited liability, but they want to have the potential for upside. Okay. So now, so to answer the question, if the stock ends up at 98, oh, wait a second, I'm sorry, I think I misinterpreted. So let's stop for a second. If the stock drops to 98, then we'll lose $3 per share. But here it says, so let me be sure that we're clear. It's a June option. We bought it for $3, has a strike of 100, and the stock currently trades at 98. Now, if the stock currently trades at 98, right, and by the expiration it goes to 108, as the example gives, it's saying what is your profit here? Okay, so your profit here is going to be, this profit here is made up of a couple pieces. One is you're going to buy a stock and you're going to get, so there's a positive sign, you're going to get a stock worth $108 per share. You're going to give up $100 per share because that's the strike price. So you're going to make this $8, what's sometimes called a payoff, but it's going to cost you a $3 premium to buy it. So you make a $5 profit on this call option if the stock goes to 108. Notice it really didn't matter that the stock price was at $98 per share. Do you notice that? Could have been anywhere per share. I'm saying what happens to the value of this option at expiration and the stock turns out to be 108. What happens if the stock turns out to be $99 a share? Well, we're going to lose our $3 at $99 or $98 it ends up. Anything below 100 or below, we're going to lose our $3. So that's basically the risk and return profile for a call option that you've purchased. Now let's look at put options, which are the other major type of option out there. A put option is the right to sell 100 shares of stock. So you're bearish on the stock. So you want to lock in a selling price, and that's what the strike price is of a put. It locks in the selling price. So you want the stock to drop in value. So let's do a put option. Before we do it, let's look at the risk and return profile in general for a put. So just blindly put this sideways T, the strike, and the stock price, and here's dollar amount, here's 0. And in this case, we're going to look at a SPY. So we're looking at a put SPY, and that stands for Standard & Poor's. It's a name for a Standard & Poor's Depository Receipt, which is sometimes called SPDRs. This is an exchange-traded fund, which we'll talk about in the next chapter. Exchange-traded funds are pretty cool. You're basically getting the action of all 500 stocks in one buy. One purchase gives you a portfolio of 500 different stocks in there. So this asset, this investment goes up and down just like the S&P 500. So when the S&P goes up 10%, you're going to make about 10%. When the S&P goes down 10%, you're going to lose about 10%. About, because it's fairly tied, but there's a few expenses associated with exchange traded funds that you need to consider, along with some of the little market idiosyncrasies, which are pretty small. So the market goes up 10%, you're basically making darn close to 10%. So let's look at the example. It's a marked put option on SPYs. It trades for $10. So the premium that I'm buying into this option is going to cost me $10 a share. Now think of these ETFs here, these exchange traded funds, these SPYs, It's just an expensive stock price. So the strike here is 1905. So just think of that as being an expensive stock. And mechanically, everything works the same as like a stock, even though it's an exchange traded fund. Okay, so the strike is 1905. It costs $10. Currently, the SPY trades at $1,900. And the question is, if the stock trades at 1902 at expiration in March, right, what is the profit or loss on the option? So, in general, the graph for a purchased put, when you buy a put option, looks like this. You're going to lose money when the stock goes up, and you're going to gain money when the stock goes down. So, if the stock is at 1902, you're somewhere right here, 1902. You're going to lose some money overall. Why? Because, well, what's going to happen is you're going to be able to sell the stock at 1905. The value of the stock that you're giving up, so you're going to get proceeds positive of 1905. You're going to give up with the negative sign 1902. A stock, you're going to give up a stock that's worth 1902. So you're going to make $3 per share in the payoff. But it cost you $10, and so you lose $7. The premium cost you $10, so you net effect is you lose $7, and that's what's going on here. You're losing $7 here. Now, what happens if the stock goes up to 1930? Well, you're going to lose your $10 total. You're going to lose your $10 because the option is out of the money. You lost your entire investment in the option, which is okay because it's capped at $10. Had you bought the S&P SPYs at 1900, these $1,900 stock, this could have went, down to 1,000. You could have lost $905, but with the per share. But with the option, you can only lose 10. Or I mean, if the stock goes up and when you short sell, because you're putting a bearish position on, then the stock has an unlimited capacity to go up. And that's one of the things you should realize. And I'm not sure if I covered that under short sales, but when you short sell a stock and the stock goes up, you have technically an infinite amount of risk because there's no cap on how high a stock can go. So you may have to buy it back at an infinite price, in theory. Okay, that was calls and puts. Now let's look at the last type of derivatives that we want to cover. And those are futures contracts, which you can buy in StockTrack. And if you ask me in class, I'll buy some or sell some. So let me give you the rundown on futures contracts. Futures contracts are contracts that you enter into. You technically don't buy them, although the slang in the textbook, and I'll often use the slang that you buy a futures contract, technically you don't. You enter into an agreement to buy or sell something in the future. That's why they're called futures. So no money changes hands. Independent, forgetting margin requirements for the moment, no money changes hands because you're not buying or selling anything now, which is the spot market, spot, S-P-O-T. You're buying and selling in the future. You're committing to buy or sell in the future. And so what you hope to do is you hope to lock in something cheap if you're buying it, and you hope to lock in a high selling price if you're on a short position for a futures contract and selling something. So let me give you an example. Suppose you're concerned that crude oil will rebound from its recent drop in price. Oil is now $35 a barrel for April delivery. So April is when the money's going to change hands. Now, with futures contracts, you're obligated. There's no option here. You're obligated to follow through with this contract. Okay. So to hedge your risk, you think that oil will go up, and you want to hedge that risk because you're going to have to buy oil in the future for whatever reason. And so you enter into a long meaning you want to buy oil. And so you enter into a long oil contract, and oil contracts typically trade for 1,000 barrels per contract. So you buy a contract, it's not just for 1 barrel, it's 1,000 barrels. So if in April oil increases to $47 a barrel, what is your profit or loss? Well, you're going to get in March. No, it's April in this case. Yeah, March was the put option. Okay, we're looking at April here. So it's $47 a barrel is what the value of what we're getting. We're getting a barrel of oil for $47. we're giving up because we locked in 35. So we're going to make $12 a barrel times 1,000 barrels, which will give us $12,000 profit in this case. Now what happens if the price of oil goes to $24? Well, we're still locked in to pay that 35, but we're receiving oil that's worth 24, and we just lost $11,000 equals. We lost $11,000 on that contract. Okay, so that's just, boy, that's basically trying to cram an entire course in about 15 minutes, looking at options and futures contracts. It doesn't really do it justice. So you're not going to really get an intuitive feel for it until you take a course like financial engineering, where we go into this in depth. Okay, so that covers chapter 3, and I'm going to cover chapter 4 briefly, a part of chapter 4 in a moment. Okay, chapter 4. Chapter 4, mutual funds and other investment companies, ICs. I'll give you some background on this. Now, investment companies is a broad term. It encompasses a number of different types of what I call plain old funds. Normally what people, when you listen to CNBC, read the Wall Street Journal, talk to people in the financial markets, they will just call investment companies just plain old funds. A mutual fund is one example of one type of investment company. And so we just call mutual funds funds often. Technically, it's an open-ended fund. We'll talk about those. There are closed-end funds. There are hedge funds. There are exchange-traded funds, exchange-traded notes, which technically are kind of like a fund. And then there's unit investment trusts, which I won't cover unit investment trusts, but they're basically a fund also. They all have what's called a net asset value, an NAV, which I'll talk about in a minute, which basically is the price at which you buy these securities, these funds at. Okay, so let's make sure we have a grip on what a fund is, or an investment company. And it's a type of financial company that owns securities and sells shares against those securities. So typically, if you buy, for example, Apple stock, you buy Apple stock, you're buying, your part ownership in the buildings and the software and the computers and all the stuff that they own on their balance sheet, and the liabilities. You have a piece of those liabilities also, because you're an equity holder. With a fund, you're buying your equity position doesn't own buildings per se. Typically, does not own buildings. It owns a portfolio of stocks or bonds. Could be some futures contract. Could be options in there, and some other derivative instruments. But usually, we'll think of it just as stocks and bonds for our case. Now, when you invest in it, you're going to invest. It's going to cost you the net asset value, which is equity per share, as I'll get to in a minute. But look, if there's a mutual fund that's worth $100,000, and by the way, there's no mutual fund that's worth $100,000. They're typically in the billions of dollars. So let's just say it's $100,000, and I go and invest $10,000 in it. I own 10% of that fund, basically. 10% of that portfolio is mine. So 10% of the income that comes off the portfolio is mine, but 10% of the liabilities are mine also, and 10% of the expenses are mine. So it's the income that comes off the portfolio minus those expenses is the income that comes into me. Okay. So that's the nature of an investment company. Your investment is equity, just like when you buy, Apple stock, you're buying an equity position. Now, NAV is a calculation of the equity per share. So net asset value per share is calculated as the market value of the assets of the fund minus its liabilities divided by the number of shares outstanding of the fund. The number of shares outstanding of the fund. So, for example, if we have a fund that's worth $10 billion and the liabilities are $500 million, and it has 1 billion shares outstanding, the net asset value is $9.50 per share. Now, what are the liabilities of a fund? Well, investment companies, they're a company with a balance sheet and income statement. And so these companies have liabilities. And what do they have liabilities for? Well, they have expenses that they may not have paid for, so it's a liability. They may have bought stocks that they haven't paid for. When you buy a stock, typically it takes 3 days between the trade date and the settlement date. What that means is the trade date is the day you decide to actually buy this security. That's your decision date. But no money trades hands, and the security doesn't trade hands either at that point because it hasn't been processed. It takes 3 days for that process to happen. So the money and the securities trade hands 3 days later. Okay, so you buy a stock, you have a liability to pay for it, and 3 days later you do pay for it. So you could have shares out, stock that you bought that you haven't paid for, or it could be there's been redemptions. People are redeeming their shares in the fund. You want your money back from the fund, but they don't give it back to you instantly. You notify them, and in a couple of days you typically will get your money back. For a mutual fund, with a hedge fund, it may get locked in there for 90 days, 6 months, or a year, depending on the terms. Now, let's look and make sure we have an understanding of how you make a return on an investment company or a mutual fund. And that's the subject of the next example on page 2 of the notes to chapter 4. It says Alpine Valley Stock Portfolio Mutual Fund. And by the way, I didn't say mutual funds are often, have specific strategies. And so some of them are growth funds, some of them are value funds, some of them specialize in small cap or mid cap or large cap or a specific sector of the market. So they have a specific strategy, and you invest your money according to that strategy, which is all spelled out in a prospectus. Now, let's look at Alpine Value Stock Portfolio. Value, which means they're trying to find, this is a portfolio that's trying to find cheap stocks, specializes in buying undervalued stocks based on low PE or high price, book the price. So you get a low PE, recall you get price divided by earnings. So if the price is low relative to earnings, that means the whole fraction is low, and that signals to some people a cheap stock. It's more complicated than that, as I'll show you later on in the semester, but that's the interpretation. It could also be, there's also another way to scale or adjust the price. Notice it's divided by earnings. Price divided by the earnings per share scales the price to see whether or not the stock is over or undervalued. You can take book value divided by price, or sometimes it's price divided by book value, but in this case I'm using book value by price. Depends on who's doing the analysis. And so here it says, you look at low book to price. So book value, high book value to price. So price is low, book value is high, so the whole fraction's high. That could signal a cheap stock because the price is low relative to its historical book value per share. This is equity per share on a market basis. This is equity per share based on a historical accounting basis. Okay, so the NAV per share at the beginning of the year was 1902. 1902 at the beginning. And at the end, it was $20.16, and the fund paid a $2.25 dividend in that time period. So the question asks, what's the total return on its components? So the total return is going to be price at the end minus the beginning price plus the cash flow, which was dividends divided by price at the beginning. Which is, look, you bought something for 1902. A little while later, it's now worth 2016. That's your capital gain in dollars. Divided by your price you paid. It's now in a decimal form or like a percent. Okay. Now let's do the dividend yield. Your dividend yield is the dividend you get divided by your initial cost, and that will give you 6% plus 11.8 for a total of 17.8%. Read that. 17.8% is your total return. 6% comes from capital gains, and near 12% comes from dividends. Okay. Now, let's look at the motivation for investment companies or funds in general. There are, there's just thousands of mutual funds out there, thousands of funds or investment companies, including exchange-traded funds, ordinary mutual funds, hedge funds, and so on. There's just thousands, and so there's trillions of dollars locked up in this. You got to ask yourself, if there's that big of a supply, there must be that big of a demand, right? Supply equals demand. So why are these things so popular, and why are companies so interested in supplying them? Well, you know why companies are supplying them, because they're making a buck off them, right? But investors are getting something out of it too. So let's see what they're getting out of it. There's three main reasons for an investment companies' existence. One is economies of scale. Remember, economies of scale from microeconomics. So in general microeconomics terms, you had your average cost per unit of widgets or whatever good you were looking at. And here you had the size of your plant or your manufacturing facility. And what you found was that, look, when you had economies of scale and you increased the amount you were producing, your costs came down because you have specialization, you have taking specialization effects that people can specialize more and they'll get better at doing things. And then you also have your fixed costs coming down because they're spreading among more units. And then eventually what happens is your costs start to increase. They start to increase, and you get diseconomies of scale. Now, you can't generally have this. You might think, oh, well, why don't costs just come down like this and continue to go down? Well, if that was the case, it would be called a natural monopoly. Natural monopolies are where you never get this diseconomies of scale. So when you have a natural, what it's called a natural monopoly, meaning that the firm will get bigger and bigger and bigger and have such an advantage that nobody can ever come into the market and take over this company because it's got the lowest cost per unit. It never experiences this diseconomies of scale. So you get a natural monopoly if your cost curves look like this, your long-run average cost curves, which is very, very rare. Like the utilities would be an example where you have a monopoly, and so the more, historically, the more lines you put up and so on and so forth brings your costs down. We're going to ignore that, and we're going to look at the typical example is diseconomies of scale occurring, and there's some sweet spot here somewhere where there's an optimal size. Now, in terms of mutual funds, this same concept holds, this concept right here with the diseconomies of scale. You're not going to find one that does this. So this is out. This is your cost per dollar invested with a mutual fund. Cost per dollar invested. So if you invest $1, maybe it's 10 cents up here. Maybe it's a nickel here. And when you get way down here, this point is really, really low for some funds. It's 1/10 of 1%. That's how low it is, which is really small dollar amounts. It's 1/10 of a penny, basically, is at the bottom. So which ones have expense ratios that low? Like a mutual fund that's an index fund, like Vanguard's index fund for the S&P 500, or a Spider exchange-traded fund will have really low average costs. Some funds meet this. It's very hard in general in normal business to figure out where this sweet spot is. It's a little easier with mutual funds because you can figure out the expense ratio and compare it to other businesses that have to disclose that expense ratio is required in their reports. So some funds, what happens is they get to this point and their expense ratio starts to increase because they start getting diseconomies of scale. And so if you recall this, the story for diseconomies of scale was the firm got too big and too unwieldy and too out of control, and it's just hard to manage, and so costs end up skyrocketing eventually. With mutual funds, the same thing happens. They get diseconomies of scale, and Peter Lynch who ran Fidelity's Magellan Fund a long time ago, said it nicely. He said, look, you know, our fund, it was so big, it was the biggest at the time, in the billions and billions of dollars. He said, you know, in order for us to take a position, we needed to buy like $1 billion, you know, like $500 million or $1 billion worth of stock at a time. There's not a lot of companies that were, you know, attractive to us in the United States. We had already owned most of them, and the ones we didn't own, we didn't really want. So we had to look overseas, and so we had to get more and more investment and analysts and people to track those overseas investments, and so his costs started to go up. And you go up in this direction. So what some funds do, Vanguard, for example, Vanguard is a mutual fund sponsor that creates mutual funds and manages them, often will close a fund that gets too big, because when they start seeing their expense ratio creep up, they cap the size of the fund, so they won't let new investors into the fund. And they get capped off, expenses stay manageable. So that's why, for example, they have a Windsor 1 and a Windsor 2 fund. If you go to Vanguard's website, the reason why they have a Windsor 2 is because Windsor 1 got too big and the expenses started building. Okay, the second reason for the prevalence of mutual funds is their diversification effects, which we'll be studying much more, the concept of diversification when we get to later chapters. I did that wrong. We get the portfolio theory. So here's diversification. Here you have your number of securities that you own here, the randomly selected securities, and here you have risk on this. And so you have what's called I call the sliding board graph. The sliding board graph breaks down total risk, which is unsystemic risk plus systemic risk, or systematic, however you want to word it. This is measured by sigma that we looked at in chapter 1. And this area right here is your systemic, and this is your unsystemic right here. And your total is this line. So what it says is, as you start at 0 securities, as you add more and more securities to your portfolio, randomly selected, that's important, your risks come down significantly at first, and they level off at one point, to the point where you get all market risk, because you own the market when you're way out here. And what it says is company-specific risk nets out. It all nets out, it goes away, and you're out here in this area. So beta measures systemic risk, recall, and your total risk is measured by sigma. So what you get here is you get, through diversification, because most funds are in the billions of dollars, you get tons of diversification, and that's what benefits investors, because it's very hard for you and I to be able to do that and manage it properly. So as you can see, all of finance boils down to risk and return, and so it boils down to risk and return. That's what investors care about. So you have low costs through economies of scale, and you have low risk through diversification. Now, when you have low costs, that means low costs translate into a higher return for investors like you and I buying into the funds. Now, the third reason for a mutual fund, and you'll appreciate this at the end of the semester when you finish up Stock Track, is that you get professional management, and somebody makes all this buying, the selling, and bookkeeping decisions are all made for you, and you get nice statements in the mail, and you get internet access, and you get tax advice, and so on and so forth. They'll help you through your tax return. But all that bookkeeping and tax consequences and risk tracking, buying and selling decisions, all made for you, and it's very convenient, which is why a lot of people who know nothing about the markets can invest in mutual funds on their own. Okay, let's get into the various types of investment companies. There are money market funds, closed-end funds, open-end funds, hedge funds, exchange-traded funds, and exchange-traded notes, which are technically not a fund, but they sure look and smell like it. We'll talk about that. Let's look at money market funds very briefly. It's a fund that owns primarily money market instruments that we talked about in the previous chapter. So they'll own T-bills, CDs, repurchase agreements, all sorts of short-term debt. And so what's cool about these things is they typically have a net asset value fixed at $1 per share. And the way they keep the net asset value fixed at $1 per share is that they're buying very low risk securities, so it doesn't deviate. There's not much volatility in it. And so what these underlying securities do is they accrete in value, they gain in value over time by a little bit. And as soon as the NAV at the end of the day creeps up over $1, they declare a dividend. You declare a dividend, the net asset value, the equity comes back down to $1. So they keep the NAV constant, so you always know what the net asset value is, and you kind of always know what you have in your account. And so you can write checks against these accounts. They're checkable, and people treat them like they do bank savings accounts, but the rates of return are a bit higher than we would get in a bank. Those money market funds are an important component, but they're used for liquidity. You're not going to get much of a return out of it. And you give up the return for that liquidity. Now, the second type of fund is a closed-end fund. These things are kind of like mutual funds, but closed-end funds are not mutual funds. Closed-end funds basically does an IPO, an initial public offering, sells shares to the public, and that's it. It stays fixed. The number of shares outstanding stays fixed. Okay? So closed-end funds now, they can be actively or passively managed. So these, you give money to a professional manager, they could be trying to beat the market, or they could be just trying to index against the market, which is a passive strategy. Closed-end funds generally do not stand ready to buy back their shares. So if you want to redeem your shares, you're going to have to buy and sell these things through your broker. Is typically how it's going to work, which means you're not directly working with the sponsor of the company that sold you these securities technically. That eliminates a lot of the costs on the part of the sponsor, so the fees are lower on these things. So if you go to a mutual fund complex that has open-ended funds, for example, where you deal with the sponsor and you redeem your money with the sponsor, and you deal questions about your portfolio and things, that takes an army of analysts and an army of people who man telephones nearly 24/7. They answer people's questions and help them trade from one account to the next. They want to close an account and open up another account. They want to move money from one fund to the next. That's all done behind the scenes, and it costs a lot of money. With closed-end funds, sponsors don't have to worry about that, because the shares trade independent of the firm. It's sort of like Apple. Apple, or any common stock, they issue the stock, and you're going to be buying and selling thousands, if not millions, of shares back and forth. You're not really dealing with Apple. You're dealing with brokers who own shares of it. So that's what's going on here. You're basically owning shares that are traded kind of like a stock is traded for the most part. Now, the price at which these things trade is, again, the net asset value. There's a net asset value determined at 4 o'clock based on 4 o'clock prices, and that's the price you're going to end up paying. Now, with closed-end funds, sometimes the price of the fund that trades like on an exchange, those closed-end funds will trade on the New York Stock Exchange or the over-the-counter market. Those prices, the actual price may deviate from the actual net asset value, the value of the underlying securities, which means these things trade at a premium or discount relative to their net asset value. Typically, it's not too far. The price that the shares trade are not too far from the net asset value, but occasionally it can go far, and that's extremely puzzling to economists and to finance people, why they deviate so much in terms of a premium or discount being large. There's a couple of reasons, but they're still not satisfactory reasons. It could be taxes. For example, part of the net asset value per share that you pay may be due to capital appreciation. So it's called buying a tax liability, and it works something like this. Suppose you buy a fund for $10 a share, right? You buy a fund, and typically this happens at the end of the year in December. You buy a fund that has $10 per share, and immediately it pays a $2 dividend. And when it pays a $2 dividend, the net asset value will drop by $2. It'll drop to $8 per share. because it just paid $2 to its shareholders, and $2 went out the door of the investment company, and it went into your pocket. So you're thinking, wow, okay, my NAV is $8. I just got $2 in my pocket, so I'm still whole. I'm perfectly whole here. But you're really not. And why are you not? Because you're going to end up, if as soon as you buy this today and the next day you get a dividend, you're going to have to pay taxes on that dividend. So if you, let's say you have a really high tax bracket, 50%, you're going to have to pay $1 in taxes. So you're really down to $9. You just bought yourself a tax liability by buying a mutual fund that was just ready to pay a dividend. So what you're better off doing is waiting to the next day, buying it at $8 per share rather than the 10, and ending up with 9. You buy it for 8, and you're better off. Those types of tax issues are what can cause a discount, for example, to some funds. Because investors, if they're smart, they're going to know that this fund has a dividend that's going to be paid. They know it's going to be a tax liability, so what they do is they trade the net asset, the price of the closed-end fund at a discount. There's also could be a portfolio effect, which could account for a premium. So, it costs some money to assemble a closed-end fund of, say, 40 stocks in a particular industry or sector. And that those 40 stocks, it costs money to put that together, and time and effort. And so investors may pay a premium for that convenience by getting that portfolio. And that can cause a slight premium. But both of these, if you really look hard, and people have looked at this very, very hard, you look at the tax story and you look at the portfolio effect story, they don't add up to some of the premiums and discounts you actually see. So it's what we call the closed-end fund puzzle. There's a puzzle as to why they deviate, why the actual stock price, the stock price of the closed-end fund trades differently than the underlying value of the securities. You'd think there'd be an arbitrage opportunity there, where you could buy what's cheap and sell what's expensive. But no, still a puzzle. Okay, open-ended funds, that's basically what we're talking about most of the time. Most mutual funds are, well, the term mutual fund really means open-ended. And what that means is the fund is ready to sell new shares all the time to investors. And that's attractive to companies, sponsors that sell mutual funds and funds in general, because what happens is if you get a hot fund, a fund that does really well, it gets advertised in the Wall Street Journal, Forbes, Business Week, and all those listings of the hottest mutual funds out there. And investors look at that and they say, oh, wow, this was a great fund last month or last quarter, and they start buying. And when they start buying, the fund sells more and more shares. And more shares, the more the assets of the fund go up. And the fees that the sponsor collects from the fund is a percentage of the market value of the fund, basically a percentage of the net assets of the fund. And so when the net assets of the fund go sky high, the portfolio, the sponsor makes sky high fees off it. And so that gives the incentive to do that. But investors want to do that. They want to chase returns. This is a good time to tell you that, yeah, it is chasing returns. The average investor underperforms the market, in part because they chase returns. They find portfolios or stocks or mutual funds that have increased in value, buy high only to get disappointed, and sell when it drops. So they buy high and sell low. Exact opposite of what they do. So there's lots of examples and studies of how people underperform the market because of that timing. Their timing. Okay, there's also hedge funds out there. That's another type of fund. Hedge funds now, they're generally not overseen by the Securities and Exchange Commission like open-ended and closed-end funds. Closed-end and open-ended funds are heavily regulated by the Securities and Exchange Commission, but hedge funds are not, because hedge funds are for wealthier investors, and sometimes called accredited investors. And an accredited investor typically needs to have a net worth, excluding their residence, of $2.5 million. They need to have an income of a certain amount for a couple of years, history of a couple of years worth of high income. And the Securities and Exchange Commission considers those people as informed investors, and so they don't need the supervision that the ordinary investor needs and the regulation that ordinary investors demand, so they don't get ripped off. So hedge funds, because they're not as regulated with the Securities and Exchange Commission, that's where all the, well, not all, but most of the scandals that have taken place in the finance and the fund world is in hedge funds. You know, the Bernie Madoff story and the $50 billion that were lost, or whatever it ultimately ended up to be. And the other pyramid stories, they were primarily hedge funds. So with a hedge fund, you put your money into the hedge fund, and it typically can get locked up for a period of 6 months, a year, meaning you can't redeem your shares like you can with a mutual fund until there's a certain period. There's a certain open period, like a window that opens up for a period of time you can redeem your shares. And the reason for that, locking that money up, is that the hedge fund may have sophisticated strategies that don't want to get disrupted. They don't want disrupted, and they want to be prepared. So they get prepared for when the window opens for some disruption. And the rest of the time, they have sophisticated strategies that they want to keep locked in. Imagine if you ran your stock track portfolio for a client, and your client kept constantly withdrawing and adding money to your portfolio. You would have to constantly sell securities that you may not want to sell and buy securities at a time you may not want to buy. You'll be forced to do it because you're going to get money in and money is going to go out. So hedge funds try to prevent that and reduce that effect by having windows of period when they can you can redeem your shares and you can buy into the fund. Let's see. The other thing with hedge funds is that they have a different type of management fee situation called a high water mark. And here's how it works. Normally, let me first compare it to a regular mutual fund. The regular mutual fund, the sponsor will charge a fixed fee. It could be 1%, 0.5%, or 0.25%. And whatever the net asset value is of the fund, they'll charge that percent. And sometimes when the fund gets bigger, they'll charge a reduced amount because they're thinking economies of scale, so they'll charge a little bit lower expenses. But with a hedge fund, there's what's called a hedge. There's a hedge fund, a high water mark type story here, where the fund manager will often collect 1 or 2% of net asset value, which is quite high. Okay, and again, they're collecting it because they're supposedly making a really good return because the money's locked up for a period of time. Plus, not only will they collect 1 or 2% no matter what happens, good or poor performance, they'll collect, say, a 20 to 40% of the profits above a high water mark. They'll collect that 20 to 40% of profits and take that as an expense on your part. It's expense on your part. It's income to them. So what a high water mark is this? I'll show you in a graph. A high water mark looks like this. Suppose this is the net asset value of the fund. So when the fund is low in value and it's going up, they'll charge this high water mark up to this point. And when the fund starts losing value, they will not charge that 20 to 40% fee. They won't charge anything, and they won't charge it when it starts rebounding either. They won't do it until they hit this high water mark again. Then they're going to start charging fees here. They start charging their fees, and then they're going to stop charging their fees here. And they're going to stop charging their fees and stop charging until they get back to the new high water mark, which is right here. Then they start charging their fees. So they're not collecting on the downside at all. They're only collecting on the upside of things. And so that's how high water marks work, and that's the way a lot of hedge funds operate with that type of expense ratio. Now, there's also the next one is called exchange-traded funds, which I've referred to a million times in the course, ETFs. They're by far one of the best things that's happened on Wall Street in 20 years is these ETFs. They're tradable. So with a regular mutual fund, you can't really trade your shares in a mutual fund. You've got to redeem them with the sponsor. You don't have any choice. with exchange traded funds, you can buy shares of a portfolio and trade them like a stock. So in StockTrack, you trade exchange traded funds in a stock pit, not the mutual fund pit. And these things, you can short exchange traded funds like a stock. You can buy them on margin. You can't short a mutual fund. You can't buy a mutual fund on margin. But you can do exchange traded funds shorting and margin. And you can trade them all day. You can't trade a mutual fund all day. You're stuck at buying the fund at a price set at 4 o'clock closing. So mutual funds are really good for long-term investing for your retirement, but they're generally not good if you want to trade in any way, dart in and out of the market. So and ETFs, by the way, can be good for your long-term investing. You're just going to pay a $10, maybe $7, $8 commission for it, like a stock commission, typically. Now, there's thousands of different kinds of exchange-traded funds. You just do a hit on the Google, and you'll look, different types of exchange-traded funds. You'll find hundreds of them, thousands of them. What I want to call to your attention is the leveraged ETFs, because I know I have a lot of students that buy leveraged ETFs. And leveraged ETFs often have something like a 2x or a 3x, or they're called 2x inverse. Okay, inverse. And let me explain what that means. When you see a 2x or a 3x fund, what that means is it's leveraged somehow using derivatives, so that if the portfolio goes up 1%, you're going to make 2% on a 2x fund. If the stock goes down 1%, you're going to lose 2%. With a 3x fund, you're leveraged, derivatives contracts and futures contracts and options, that if the stock goes up 1%, you're going to make 3%, and if the stock goes down 1%, you're going to lose 3%. So it's magnified. Okay, those things are fine to buy in StockTrack and experience them, but I would not buy them personally. In the real world, you probably want to stay away from them, because you got this geometric return effect that you need to be careful of. And so these things are great if you invest for a couple of days at most, but if you invest for more than a couple of days, you're going to get caught up into the volatility, and that volatility is going to work against you. So let's say you buy something at a dollar, right? And it goes up 20% to $1.20, and then it goes down 20%. Okay, so it goes up 20%, and then it goes down 20%. Well, if it goes up 20%, I'll get my calculator here. If it goes up 20%, it goes from $1 to $1.20, and if it goes from $1.20 down 20%, multiply that by 0.8, you're down to 96 cents. So what happens with these 2 and 3 leveraged funds is you get a 20% return here, and you get a minus 20% return for this second move. So you're going up and then down. But notice you go up and you go down, you're not back to where you started at $1. You're 4 cents below in that case. And that's with being unleveraged now. At this example, let's be clear that this is unleveraged. You invest $1, you go up to 1.2, go down to 96. Now, if you're leveraged, this loss of 4 cents that you have is going to be multiplied by 2 or multiplied by 3. And if this happens every day, the fund goes up, the fund goes down, you're losing some of that effect of the geometric, the difference between a geometric return and an average return that we saw back in Chapter 1. So in the real world, you want to stay clear of these funds for long-term investing, leveraged funds. And there's lots of articles to read where it shows you want to stay clear of these things. Now, inverse, a 2x inverse, or just an inverse fund, would mean if the underlying portfolio goes up 20%, or the underlying index or whatever you're invested in goes up 20%, you lose 20%, and if it goes down 20%, you gain 20%. It moves the opposite of what the underlying index does. Those are called inverse funds, and you could have, I guess, leveraged inverse funds and all sorts of twists on these concepts. Now, the other tip I want to give, that's one tip. So avoid those 3x, 2x, unless you want to experiment in stock tracking. I'm perfectly fine with that for experimentation. The other tip is, look, if you want to buy bonds, you're better off buying bond ETFs. And so Google up bond ETFs. There's bunches of them out there. And the reason why you want to do that, you get instant diversification through hundreds of bonds. In order for you to buy a bond position effectively and cheaply, you need to buy like 50 bonds, which is $50,000 worth of bonds. Otherwise, you're going to be paying commissions through the roof. And so you can avoid all that by buying an exchange-traded fund, bond fund. And not only that, but you can't short bonds in the real world, but you can short ETF bond funds, for example, and so you can get short positions in bonds. So if you think interest rates are going to go up, then maybe a short bond fund will be the thing that you want. But keep in mind, you're going to have to pay that dividend, and there's going to be a constant dividend on those things because they invest in bonds that pay coupons that are pretty fixed. Okay, let's see. The last type of fund that I want to look at today is exchange traded notes, ETNs. And boy, that sounds a lot like ETFs. So most people confuse them for ETFs. They look and they smell just like an ETF, but they're not. They're technically a loan. That's what the word note is. Remember notes payable from accounting? And a note is something you owe money on, like for example, with a bank, or you have treasury notes. It's debt. And so ETNs are exchange traded notes. They trade on an exchange. So you can buy them and sell them just like you do ETFs. But you're basically a creditor. You've lent money to a company. You didn't buy an equity position in a company. You lent money. You're a general creditor. Read the prospectus and it'll tell you that you're basically a general creditor. So if the company goes belly up, you're like last in line for your money to get your money back under these things. Because you lent money to the company, so you don't really have an equity position in a portfolio of stocks, for example. Let's see, what else do I need to say here? My advice is to stay clear of those things. Those exchange traded notes are kind of dicey. They often invest in derivative instruments. And it could be VIXs, for example, volatility indexes. And I'll talk about VIXs later. The VIX is an instrument that you can buy or sell using futures contracts. But sometimes exchange-traded notes funds will buy VIX, and they'll be VIX-based instruments. I can explain that better in class if you ask me. If you don't have a handle on what VIX is, the VIX, then you're going to have a hard time understanding what an exchange-traded note that invests primarily in VIXs are. But they're out there, but stay away from them. But in StockTrack, since it's play money, you can do it and learn something maybe from it. Okay, so that's all I want to cover here in class. I'll pick up with fees and expenses of investment companies.